Good afternoon and welcome to this exclusive webinar. Once again, it's about how to make money work for you. The myth and the reality debate starts now. My name is Clive Angwenyi. I'll be your host for today's engaging, insightful discussion. And on behalf of Octagon Africa and Jubilee Insurance, we are delighted to have you join us this afternoon as we uncover the truths, dispel the myths, and equip you with the tools to make smarter financial decisions. This partnership between Octagon and Jubilee Insurance represents a shared vision, empowering individuals, entrepreneurs, and professionals to take charge of their financial features. We encourage everyone, once again, tuned in to participate actively, share your thoughts, questions, experiences. We want to hear all those stories around money. How is your experience interacting with money? Ask all the questions, all the queries, all the areas you want us to demystify today around money. We'll pick a few questions to discuss live throughout the session. Remember, we're coming to you live this afternoon. To kick us off, I'd like to introduce our speakers for today's conversation. And our first speaker joining us from Octagon Africa, we have Tony Amuhale, Head of Business Development, and Miranda Wanjala, who is the Head of Finance. Both are experts in financial planning, pensions, and investment strategies. And from Jubilee Insurance, we are honored to have Mr. Munge Shege, Head of Alternative Distribution and Partnerships, who will later take us through an investment product designed to help you make your money work truly for you. Let's start off with brief introductions and opening remarks from our panelists. And going up first is Miranda. Over to you, Miranda.
Thank you, Clay. I am happy to be here and interact with you. My name, as has been said, is Miranda Wanjala. I am Head of Finance at Octagon Africa, and I am also very passionate about helping people understand how their day-to-day habits affect their financial well-being on overall. So today, looking forward to unpacking some of the biggest myths we have surrounding matters personal finances and other issues that may hold us back from achieving that which we wish to achieve in as far as our financial independence is concerned, and how just a shift of mindset can propel you in the right direction towards wealth creation. Thank you.
Thank you, Miranda. We now move on to Tony.
Good afternoon, colleagues and friends. My name is Tony Amhale, Head of Business Development, Octagon Africa, in charge of making sure that we develop a product that meets the client expectation, and also you can tailor-make a product that suits your needs and benefits. Our desire is make sure that we work with you, and where I sit as the Head of Business Development, I make sure that you understand the product you are buying, so that you don't just buy a product for the sake of. We make sure that we journey with you, and I'm happy to be here to be able to understand and give insights in regards to saving, and also to make sure that we understand the difference between money and how money can work for you. Thank you, Clive.
Thank you, Tony. Last but not least, we have Munge.
Good afternoon to all of you. My name is Munge Chege from Jubilee Life. A great pleasure to be with you. Thank you for joining us. I work with Jubilee heading the Alternative Distribution Partnerships Department, where we are spearheading innovation in terms of the kind of solutions we offer you as our clients to Octagon, as well as to look at flexible ways to be able to make sure that you're reaping maximum benefits from the financial services here. Thank you, and back to you, Clive.
Thank you so much, Munge. Great ladies and gentlemen, as you can see, we have assembled human capital, human artillery, human armory, seasoned experts that are going to help us navigate this conversation around money. We are going to talk about money, and we are going to debunk all the myths versus the reality. Once again, for those that have just joined us, remember the chat tab is yours. Please post all your questions, all the concerns you have, all the comments, all the stories. We're in the mood for some money stories this afternoon. Please post them on the chat tab, and I'll be reaching out to your questions, your comments as the session goes on. So thank you so much to all our speakers for setting a firm runway for us to take off. Let's now dive into the heart of our discussion, the myth versus reality debate. So I'm going to position some questions to our speakers from Octagon. So these are some of the questions that we have put together based on experience interacting with various markets. So the first question is around a common myth. And this question will position for Tony to help us. So most people say I am too young to worry about retirement. Now, Tony, many young professionals think retirement is far away. Why is time such a critical factor in wealth creation?
Okay, thank you so much, Clive. Just to help our members who have already logged in to understand the myth between the factors of time in regards to saving, also in regards to retirement planning. Basically, when you come to matter of saving, you discover that time is a factor, and also the longevity you have for you to meet your target. Now, there has been this myth around that saving is for the old people so that they can save and have a decent retirement. And where we sit, or where I sit, is so much clear that you must start early for you to have enough money in retirement. Now, allow me just to talk about numbers. The issue of compound interest and compounded time factor is of essence when it comes to matter of saving for your retirement. And that now explain and become a factor for some of us who look at age being just a number. Now, if you are to start early, let us say you are age 25 and you are in the call, you want to start saving. There has been a confirmation that you will have, like, let us say 35 years to save for you to clock at 60, being the age of Kenyan retirement age, the normal retirement age. So you have like 35 years for you to save, and with 35 years having for you to meet your target, you discover that you will be saving at a minimum of, let us say, 1,000 bob. If you are to save 1,000 bob for the next of 35 years, I can assure you will have like almost 5 million for your retirement. But if you are to start late means that you are starting at 50 or 55. You'll be pushed to make sure that you save more in terms of deposits, so that you are able to make sure that you increase your basket. And that level that it makes sure that it may be difficult for you to raise more, because now that will be affecting also your disposable income. Now, the compound interest, for the long time you have, it means that you earn more on the income that is being compounded for that long time years. And also you'll be having an opportunity when you start early to start saving small amount. And small amount, as I earlier alluded to, you can be start from 1,000, 2,000, and that will end up having more money because of part of the interest. And because the interest is compounded, and also you will be in opportunity to take risk, and when you are still young, to make sure that you are able to diversify, and also in case you have a false start, you'll have another opportunity to restart again. So that myth of too young to worry about retirement. Retirement is real. The moment you are given for us who are in a workspace, you discover that the moment you get an appointment letter is an assurance that also the retirement letter is also on the way. So you have to take the opportunity to start saving early. And when you start saving early, you'll have all the room to grow it to the expected projected budget for your amount. Back to you, Cliff.
Yes, indeed, ladies and gentlemen, you've heard it straight from our expert that indeed retirement is not far away. Take advantage of the eighth wonder of the world, and that is compound interest. Now, moving on swiftly to myth number 2. Some people say investing is only for the rich. What advice would you give someone who earns modestly but wants to start investing today? What would you tell them, Miranda?
I think the first question would be, how did the rich get there? Because they definitely started somewhere. So with your modest income, whatever it is that you think is modest income, you can be able to make a plan, a budget, so to speak, and ensure that you put away something for the future, for that time when you will no longer be able to work and actively generate income. So we are using the money we have now to invest for the future so that we can generate passive income for that time when you cannot work. And that applies both to those who are in employment and those who are engaged in business, because things happen. For example, what happens if one day something happens and you're not able to run that business anymore? You then fall back to your passive income. What happens when you are now old enough and you feel like I can't keep up with this, the daily grind? Then again, you fall back to your passive income. So if you decide that it is only for the rich, or if you decide I don't have enough money today to start the journey of saving and investing, you will never be ready, because money has never been enough. Anytime you make slightly more money, I think you get excited maybe the first 2 times you handle that amount of money. Beyond that, it becomes the norm. Your life adjusts upwards, what we refer to as lifestyle inflation. Then the cycle continues. So if you've already set for yourself that saving and investing is a must-have, then even as seasons in life change, you will be able to move with them, take them in stride. Back to you, Clive.
Thank you, Miranda. Miranda, there, our other speaker, just unpacking that response and mentioning a magic word, budget, the budget that helps us call money by its name. Remember, if you don't call money by its name, it finds a name, and that name is usually impulse buying. Now, Tony, once again, we have another myth here, myth number 3. There are some people who feel they can beat the market by investing on their own. I've done a course on finance, I've done a BCom, I want to invest on my own. What would you tell this person in terms of why is professional fund management important in investment growth and risk reduction?
Thank you so much, Cliff. And just to mention the myth about you can beat the market by investing on your own, that's one of the risks that most of us we find ourselves into, believing that I can do everything on my own. That's one of the greatest risks you can find yourself in. This is just an encouragement that you require a professional to help you understand the risks that you intend into. And as you appreciate the issue to do with the money, it is a higher risk because currently, with the current market, you discover there are those fraudsters who are looking forward to get that money from you without you knowing. And there's a time you can discover that there's a risk that you cannot accommodate. So for the professional, when you bring a professional on board, he'll be able to guide or gauge your risk appetite and guide you accordingly. So basically, the purpose of the fund manager, who is a professional, who does this day-to-day basis, he'll be able to pinpoint and be able to guide you. If you venture here, you are more likely to lose your money, and basically losing your money means going back again to start afresh to see if again you can build again so that you can have some certainty for you for saving of your future. So purely what we encourage so much is to make sure that one, for the professional fund manager, will be able to give you the risk and also look at your risk appetite and also advise where to venture to. Two is to make sure that the risk is reduced. Okay, because all of us, we are not in the space of money, understanding money, how money works and how you can venture. So what we're encouraging is that myth of beat the market by investing for your own. Yes, you are looking at to reducing the cost. Maybe that's the thing most of us look at. Let us reduce the cost of paying that advisor. However, there's a risk as well. You might as well lose the entire money for that. So thirdly, also to diversify and bring more idea and also open up your mind, because you discover some of us, we are only inclined to one specific investment model, but with a professional fund manager that gives you a variety. So by that means you can open up your mind and spread your risk, whereby you discover if you are a risk taker, you can go to high-end risk business and give you a better return. If you are a risk-averse person, it means that you ultimately take your money where your capital is preserved. And by that case, we are readily available to work with you to make sure that whichever model you wish, we are able to blend and also give you the better way to do it. And also under the professionals, you discover is that we'll be able to give you a questionnaire so that you're able to gauge what character of a person are you. Because your way of investment may be only one way, which that you may be easy access to your money. Back to Clive.
Thank you, Tony. Indeed, seek professional help. Ladies and gentlemen, remember we have mapped out 7 common key myths about money as we transition to myth number 4. Remember, the chat tab is yours. Post all your questions, all your queries, all the comments, and the experts will be responding to them. Now, Miranda, moving on to myth number 4. There are some people who say saving in a bank account is enough. As a matter of fact, people say that when you view your bank balance statement on your mobile app, it can cure 1,001 diseases. Please help us understand, why does keeping money in a savings account actually lose value over time?
At the risk of exposing my big age, I will start with when I was young, I think in lower primary school. I remember we used to buy a loaf of bread at 16 shillings because you would be given 20 bob, you go to the shop, you come back home with 4 bob. Right now, that same, first of all, it used to be 500 grams. Right now, 400 grams, a loaf of 400 grams is 70 shillings. And the only thing that has changed mainly is time. So in that time, that loaf of bread, the price has grown by about 437%. So imagine you have your money in the bank. If it was 1,000 shillings then, it is still 1,000 shillings today, or probably has earned a marginal interest of maybe 1% per annum. But meanwhile, the things that you need to buy with that 1,000 shillings are becoming more costly. And this is the effect of what we call inflation. So the only way you will beat inflation is by investing your money somewhere where it will get you a return that is higher than the current rate of inflation. If you are losing 1% per annum and your investment is giving you 1%, then you are at par. If your investment is giving you 2% vis-a-vis the 1% loss, then you are beating inflation and you're in a better off position whereby your money is not losing value. Now, unfortunately, banks are businesses. We have nothing against them. So their business is to make money off you. That money you go and park in your account, they will lend it to the rest of us at a rate of, I think right now it's around 17, 18 for personal loans. And at best, maybe they'll give you 5% as a return if it is a savings account. If it is just a current account, your return is 0. So no, it is good to see a bank balance of say 500,000 shillings, but that money is losing value just by sitting there. I'm sure a few years ago that 500 could buy you property in a very prime area. Today you will struggle. You will get property at that price, but maybe infrastructure will not be non-existent, or distance from just basic social amenities will be a problem. So you are better off putting that money to work. Let it work for you. And then when you actually need to use it, then you can pull it out and utilize it at that point. So yes, money loses value due to the phenomena called inflation, and keeping it in a bank account it looks good. You might say you're conservative, you're scared of losing your money, but in the long run, the only person you're doing a disservice to is yourself as the owner of that money. Back to you, Clive.
Thank you, Miranda. Ladies and gentlemen, you heard it straight from our expert. Let the money come out and work for you so that you take advantage of the opportunity to invest and get positive returns instead of letting the money sit in your bank account. Now, Tony, there are some people who feel, and it happens to most of us, and people feel that ordinary people should not invest, rather. That investing is too risky for ordinary people. What should you tell someone who is thinking, investment, not for me, it's too risky. Let me leave my money to sit in the bank account or under my mattress. What should you tell this person?
Thank you so much, Clay, for that question. And maybe I'll also just try to expound and say investment is very key and increases your net worth besides just saving. In most cases, people try to mix the two, saving and investment. Investment just to grow your money compared to saving by just consolidating it together without having to grow via interest. And thereafter, when we are trying to address that myth, is just that it's very interesting that investment is not that too risky, because purely if you want your money to grow, it means you must put in a place whereby it has to increase by way of earning interest. And by that juncture, I want to pause and ask myself, why do we invest? Basically, the reason of investing is capital preservation. You have to make sure that your money, whatever you have, is preserved and is also growing. First, you preserve, which means that you are able to continue and having your money intact. Two, another reason of why we invest, in a summary, is we want to make sure that it is growth by way of interest. Three will be capital accumulation. You have your capital, and by that additional income that will be coming through by way of earning return is accumulated and becomes better and bigger. Then the fourth one, as I want to take away home, will be income generation. You discover that when you are looking at it keenly in terms of how you invest your money, let me just give an example. Like, for example, investing with the government bonds, you discover you put your money, and at every 6 months or a year, you get those return, a dividend or coupons. So it's very critical that what investment does to your investment or your money you are holding. So in a nutshell, the four clear areas: you will have preserved your capital, you will have grown your capital because the money you have saved or saved somewhere and it has grown up. Also, in terms of your capital has been preserved and income has been generated, and you discover that in long run, you will have a better and higher disposable income to make sure that you end up being a rich person. Now, just to highlight and add more, where to invest or when to invest is very key to all of us. In most cases, what we advise, you must have a target in your life. And this target is your driving factor to make sure that where you want to invest is very key. So we talk about when you have to understand why and what you want to invest. That's very key to all of us, that is where to invest to. Secondly, we're also looking at when you have the funds for it. I'm happy, and I'm earlier alluded to, you must save. So after saving is where you end up having some money to invest, and by that you have higher return. Something also to highlight, when to invest, you discover that is when there's opportunity and you are buying at a lower price, and also you sell at a higher price, where it means you have been in a position to have a dividend or a return on investment. And now, finally, in terms of when to invest, is when you want to achieve your goal, you have to attain it. And that one makes sure that this one you grow it, and that myth of is too risky for ordinary people. That means all of us you have opportunity to invest whatever little you are holding, you have saved. So it's all of us to save. Back to you, Clive.
Yes, indeed. Tony, very sobering conversation right there. What's your goal? I also picked out buy low, sell high. So ladies and gentlemen, remember, today we are separating the myth from reality, blow by blow, step by step. We are crossing the T's, dotting the I's, and now we are transitioning to the next myth. We have mapped out 7 myths, so we are moving on to myth number 6. As we do that, please post on the chat tab, ask for clarifications, tell us what your goal is, so that thereafter we can have a conversation around it. Number 6 myth, Miranda. People say retirement planning ends when you stop working. True, false? Help us separate myth from reality.
Thank you, Clay. I would say false. Retirement does not end at retirement because, for example, in Kenya, most people retire at 60. There are a few who go to 60 and 70. I mean 65 and 70. But at 60, you probably have give and take 20 or more years to still live, exist, and keep paying. Some bills don't end. That you have a house does not mean, okay, you don't pay rent, but the house has to be maintained. It still needs utilities. So your expenses continue. So after retirement, your income stops. That salary has stopped. But the day-to-day expenses that keep life moving are still very much alive and still need to be settled. So if you put a hard stop, then it means now you cut off your inflows by way of, say, whatever your source of income was, but the outflows continue. So if we don't find a way to balance so that in as much as we have retired, we are still making investments here and there, saving from whatever money that we have accessible in retirement so that it can last longer, as opposed to spending all of it. For example, you buy an annuity so that you can have that continuous income, sort of monthly, almost similar to a salary. Some of them are for life. I think most of them are for life. Some have a guaranteed period, some don't. And then you can also, I'm looking for an untechnical term, but organize your investments. The word is, but the thing is balance your portfolio, your investment portfolio, so that, for example, if you are invested in stocks, the equity market, and you also have some government bonds, we all know that in most cases, those two move in opposite directions. When one is doing well, the other one is doing poorly. So the balancing is ensuring that you have spread your risk, so to speak. And that is where, as Tony had mentioned, it is important to have an investment advisor. And it is also important to not invest alone, because if we are 10 of us, the risk is spread. If I am alone, then the entire impact of that risk will hit my portfolio only. So we spread our investment portfolio to ensure that that money that we have that now is no longer coming in by virtue of the fact that we have retired lasts us long. And then also you will need, probably your health now becomes frail because it's a factor that comes with age. So you will also need resources for either paying for medical expenses or paying for medical insurance, whichever works best for you. And then inflation will also be still existing. It doesn't stop just because your income stopped. So of course, you also have to make sure, again, your returns are ahead of investments so that we stretch that money as long as it can for your the sunset years, the years after formal employment or active income generation. Back to you, Clive.
Yes, indeed. Thank you so much, Miranda. Ladies and gentlemen, you heard it. Spread the risk, balance the investment portfolio. We'll be circling back to Miranda so that she helps us understand what is the right balance when it comes to your investment portfolio. What are those things that you consider when striking the right balance when doing investments? On to our last myth before I jump onto your questions on the chat tab. Keep them coming. Some are coming in anonymously. Some have been posted on the chat tab. Remember, you also have an opportunity to raise your hand the way I've raised mine there. Thereafter, we will unmute you and you'll have an opportunity to verbalize your question. Now, on to myth number 7. Tony, some people feel it's too late to start investing. What did you tell someone who's thinking it's too late? The train has left the station. What did you tell this person?
Okay. Where we sit is not that too late to start investing, because you start from wherever you are. There are those some of us who got information of investing at a very tender age, early age. Those ones, they started at that time. But if you are hearing for the first time today, we encourage you to start it now. The challenge will be at the age you are, it will depend now how the load you are going to lift. If, for example, you are almost retiring, let us say you are 50 years and above, it means that, and you have not saved much. It means that you have to have more to save as compared to the young starters. The guys just left college and they are joining working. So for those ones, at least they have an opportunity to save and longevity compared to some of us, for some of us almost retiring. So where I sit, and as an expert, I believe the time to start saving, it's now. If you have not saved, save now. If you are already started saving, diversify your investment and save more. And that means the age is just doesn't matter so much, but where you are is going to determine the decision you're going to make outright now as compared to going forward. Back to you, Clive.
Thank you, Tony. Ladies and gentlemen, those are the 7 myths when it comes to money. Remember, today we are separating myth from reality. We are calling money by its name. Now, while the iron is still hot, Miranda, just circling back to that right balance when it comes to investment, how do you know that you have the right balance of investment? Because we have different investment asset classes.
Thank you, Clive. So you would need an expert, so to speak, to guide you through this. So normally what these experts do, they are investment advisors or investment managers. So they will want to know, what are your goals? Are you just looking to beat inflation? Are you looking to gradually grow your wealth? All those factors. And then they look at your age. How much are you available to put aside for investment purposes? Then they'll put all that together, and then they will help you come up with a balanced portfolio, which is aligned to your goals. And they will keep reviewing that, so that if the various asset classes in that portfolio are performing differently, or your goals shift because of age or life occurrences, they're able to work with you and rebalance it towards the direction that you want to go. So unfortunately, this one, unless you are the expert yourself, you will need external help. You cannot simply do it alone.
Yes,
I hope I have answered, Claire.
Yes, you have. Thank you so much for that response, Miranda. You heard it. Seek for professional help. The experts can help you in that journey of finding out, do you have the right balance when it comes to your investment portfolio? A question for you, Tony. Beyond the standard advice of make a budget, what is that one behavioral trick or psychological mindset shift you've seen to be most effective in helping people finally stick to their financial plan? Quite a loaded question there from Mike Mwange.
Thank you so much, Clive, for that question. I believe that a budget has been one of the key instruments to make sure that we stick to our goals and objectives. However, besides just a budget, all of us always believe you must also be self-disciplined for you to achieve your target. So beside the budget, we also talk about self-discipline, which all of us have, you have to adhere to. And remember that also you have a goal, and the goal is remains to be a driving factor, so that at the every end of the investment, you can sit back and look at it. Have I achieved my goal? Have I met my objective to be on this investment that I've been in? So, Clive, I'll basically say first is the discipline, two, the purpose of the investment, which is the end game, is the goal of ultimately having a financial freedom.
Discipline and purpose leading eventually to financial freedom. Thank you, Tony, for that. One of our esteemed members asks Miranda, what if I don't earn a lot? My income is too low and I'm not able to save. Why does saving feel difficult? He proceeds to add, what systems can one use to overcome this challenge?
I will start by acknowledging that yes, sometimes what you earn is just enough for survival. But then in that case, you start by investing in yourself. Increase your knowledge, increase your skills so that you are more marketable, whether it is to employers or to the people you serve as your clients if you are in business. And in that way, you will be able to grow your income to a level where you then feel that I am not only taking care of my basic needs, I have a little that I can put aside for saving. So if you feel like it's too little, start by growing that income. But you can only grow it by, again, investing in yourself. Improve yourself, make yourself more valuable. Whether value is by education, formally or informally, by way of gaining skills. And then saving is not hard, I think, but it is habits that you need to build over time. One thing it requires, it must take you living beneath your means. So when you look at whatever is your income, whether it comes in monthly or quarterly or randomly, if you are in business and it's not consistently on this date I get paid, you need to plan your life such that you don't plan to the last shilling. Actually, the best, what I have seen work for most people is before you start deciding how to spend the rest of the money, as you start your budget, the first thing should be how much of this money am I putting aside for future, whether I am saving to invest or saving to develop myself, investing it in, say, school fees or a short course, such kind of things. So then after that, then you can plan with the rest. It might be hard at first. There will be a lot of noise by way of my friends are going out. There is a new, I don't know, a shoe, a handbag for the ladies, something. There will always be something that feels very attractive, and you're feeling like, now that I am working and I have some income, let me get this for myself. But delayed gratification is the only way that you're going to conquer that. So if you start by putting aside the portion that you have decided to put aside first, it's already gone. So now the balance that I have, I distribute it amongst my needs. Then as much as you are budgeting for what you need, you also need to put a realistic amount allocation so that you can use it for not necessarily, let's call it a want. It is not something that will benefit you in a great way, but it's discretionary spending. Those things that you just do for purposes of feeling good about yourself, about the fact that you actually have an income, you can do something for yourself. Because also, if you deny yourself that at some point you might like do sort of like, I'm looking for an English word and I'm not finding it. You decide to compensate for all the time you feel like you have been denying yourself, in which case you'll end up on impulse spending. So number one, balance. And number two, prioritize that, automate the process of saving and prioritize it. Otherwise, if it's the last item on your list, by the time you get there, the money will already be done. Then we will keep saying, let's wait for the next income, and the next, and time waits for no man. Back to you, Clive. Thank you.
Thank you, Miranda. We've always grown with this statement that we should live within our means. But profound words right there, Miranda, where you're talking about living beneath or below your means so that you have extra disposable income to invest. Now, moving on to the next question on the chat tab. This is for you, Tony. Someone asks, how do you balance between risk and reward when choosing where to put your money?
Thank you so much, Clive, on that question. Is actually critical how to balance. Basically, for you, before you make a choice where to invest, is basically looking at first your age and your risk appetite. As I've already alluded to, your risk appetite uh, covers everything, because there are some of us who have said they are risk averse. There are those who are risk takers, and there are those who look at return being the ultimate what they are looking at. So for you to have the balance, what we believe and we advocate for, you look at yourself as a person and say, are you ready to let your capital go in case you are to have a major shift in the economy? And so you're looking at it objectively on the economy point of view. You have to strike the balance, say, for, like, let us say 50%, I'm ready to let it go. But again, I want to retain 50% to continue helping me move on with life. And by that virtue means that you have to play around with the return on investment, and also looking at your capital, because we appreciate that your capital is the precious thing you have accumulated for a longer time of period. And by having taken time to build on it, it will also be a factor that where you do want to invest your money. Should I invest where it can easily go away, or should I invest that as much as it can easily go away, what will be the return on investment? So, Clive, what I would just want to say basically on that question is your risk appetite and what you have and what you want to achieve basically on that level. Thank you.
Thanks, Tony. There's a thought here, opinion note by John, and Miranda, you can help us validate it after I read it out. So John says, the reason why some people opt to go about investing by themselves, avoiding professionals, is not only about the cost associated with the professional services. Yes, that might be one of the reasons. The other reason would be, in some cases, there's extremely low returns that some investment organizations are giving out on a comparative basis. Your thoughts on this statement, Miranda?
I would say choose your poison. If you truly have no clue about investments and go about it on your own, you're not even able to foresee that here there might be a pitfall. Because, and I think we've even seen that in this country in the past, there are some investment vehicles that offer you supernormal profits, returns that are way above market. So we need to be able to take a step back and interrogate. Now, there's some people who, if you have some bit of financial knowledge, you will be able to ask yourself those questions. But if you are not, you might just be driven by that high return. So you need to ask yourself, where is this money being invested? I have seen a lot of the experts normally say, if you don't understand how the money is being made, do not touch that investment. Because then you are hoping for magic. And when that magic does not happen and you lose your money, that is when, unfortunately, you will be referred to the fine print that you did not see when you decided to go into these investments. As opposed to, yes, some investment advices are expensive, but you need to weigh. You need to weigh and make a personal decision between losing my capital vis-a-vis paying some fee to this investment advisor to get professional advice, so that I don't make a decision now that will cost me my entire capital later in time. So you will require a balance. There are things that you can easily go into. For example, if you're buying a government bond, it's fairly straightforward. Chances of loss of your initial investment are next to zero, I think, depending on the stability of the government. So that one, you don't really need an advisor. You just need to get basic information on how do I go about it. And through central bank themselves, they will educate you on doing that. You don't necessarily need an investment advisor on that. But now let's go to something like they're called special funds. Return is high, risk is high. The fees that they charge for managing your investment is also high. So now that one, unless you are very financial savvy, you will need an expert to break it down to you so that you decide whether, armed with all that information that you've been given, does it then make sense for me? Does it align with my long-term investment goals to actually get myself onto this special fund investment? Does it cover my risk base? If I am risk averse, then I will stay away from it, because of course high return also comes with high risk. The same way you're likely to make very high amounts of money, you're also likely to lose very high amounts of money. So I go back to, it requires a balance. But depending on the product you choose as your investment vehicle, you may or may not need an investment advisor. Bottom line, make sure you understand what you're investing in. Back to you, Clive.
Fine response to that fine statement by John. We know on the chat tab there. Speaking of fine, Miranda talked about the fine print. What out esteemed members, sometimes the fine print is on font size 0.001 sans serif. So find the balance, do as much research as possible before you invest, and we have experts to guide you and walk you through that journey. The questions are streaming in thick and fast on the chat tab. Our chat tab is on fire. We'll take a couple of questions leading up to the top of the hour. A question from Stanley for you, Tony. How will you compare investment in money market compared to real estate? How would you compare the two?
Thank you, Stanley, for that question. And basically, allow me also to break it down in terms of what is money market and what is real estate. Then from there, we can make the comparison and see where we get value for money. Money market, ideally in a nutshell, is you take your money and you put it to a fund manager, and in return you get an investment or a profit to that. Now, what does that mean? On money market, your capital is reserved, and how to access the money is on an app. Outright, you log in the app, you're able to get your money. It's liquid and is the most liquid way of having your investment and reserve. The interest again on the same basis is minimal. Currently keep on fluctuating month per month. You discover sometimes it goes up and sometimes it goes down. However, depending on who the fund manager you have picked. To real estate, and now real estate whereby the challenge you have been having since the start of COVID, you discover that real estate, most people have tried to shy away. And basically, just to highlight issue of the office space, you discover that most uptake of office space has reduced. Employers having got opportunity for the employees to work remotely. You discover if the employer was to use a huge space, he can even cut space to 50%, even to quarter. So you discover the money market is compared to real estate. The real estate uptake, when it goes down, it means that you can't recover so much. And when you're doing evaluation of real estate, you discover you may register those negative return. But for the money market, your capital is reserved, and again, you're able to get the small return on it. So probably, having said that, I welcome my colleague Miranda to just highlight something on it.
I think you've covered it well, Tony. comparing, you're comparing tomatoes and onions, so it's tricky to compare the two. So again, it will go back to what are your goals and what would you prefer? If you have no time to chase tenants for rent, so you look for which agent who collected rent on your behalf and is not remitting the money, repair leaking taps and broken tiles, then put your money in the money market. If you have energy or resources to hire a reputable property management firm that will handle all those shenanigans that come with being a landlord, then by all means, go ahead. But also, you need to know that real estate, it takes longer to even just get your return on investment, to recover your initial investment. That's what I meant to say. To recover your initial investment, because it's capital heavy. So if you have all the money together, then it could be a good vehicle for you. If you do not have all the money, then you could start with this money market so that you use it to accumulate with the final goal of I will go into real estate if that is your vehicle of choice for investment. I think that's all I can add.
Thank you, Miranda. While you still have the microphone, and before the MMM conversation goes cold, Jocelyn has a follow-up question in terms of comparative analysis. How would you compare between money market fund, MMF, and AVC, that is additional voluntary contribution? Where will you advise one to go or to invest?
Again, there's no absolute answer. There's no one size fits all. If your goal is to save for retirement, this money, once I no longer have an income, I will use it to finance my life in my years of retirement, then go for the AVC. Because one benefit that one has is that it is not as easily accessible as the MMF. So you will not wake up tomorrow and decide, you know what, I need all this money back, and then you access it. MMF, most of them in the market right now, I think in less than 24 hours, if I put in a request for accessing my funds now, probably before this time tomorrow, I will have that money in my account or in my M-Pesa, depending. So sometimes if you are trying to save for the long term, you need to ensure that that money is not very easily accessible. Because if I see something and decide I think I want to buy that one, if I can swipe my card, I will pay for it immediately. If I have to go refill a form and do what not and what not before the money comes through, probably by the time I get halfway through filling that form, I'll decide, you know what, it was not an emergency after all. It can wait. So that in itself has helped you manage your tendency to impulse buy. So if you are looking at this is money I should use in the distant, well, not so distant future, it can go to AVC, and your goal is securing yourself for retirement, put it in that AVC, let it go there. You will benefit from the fact that it will compound over more years without you disturbing it, pinching some coins out of it. But if you are looking at maybe I am accumulating so that I can do something else, or I am just building an emergency fund, then the money market will work for you. So neither is good or bad. It just depends on what is your long-term goal. Back to you, Clive.
Yeah. All right. What is your long-term goal? That's the food for thought question from Miranda. Now, Tony, there's a loaded question here from Vincent Osuga. So if you're somewhere where you're standing, please have a seat because it's coming in from Vincent Osuga. He says, there are many institutions coming up currently that are offering investment opportunities. The investment vehicles are money market funds and special funds. Some are even offering very lucrative returns way above what traditional institutions have been offering. How safe is an investor's investment in this kind of savings? Are they regulated by CMA? Where are they investing their money to realize such high returns? When are we seeing the other financial institutions, when and why are we seeing other financial institutions struggling? Very loaded. Tony, over to you.
Okay, thank you so much, Vincent, for that question. To us, indeed, we are happy to continue understanding the MMF and special funds and also looking at the return on an investment. So before I clarify much on it, is that most of the fund managers are regulated with the CMA. However, now you as an investor, the decision to make where to invest to is a personal decision, and you need to do what you call must understand where the client, you must understand the investment manager clearly. So what we are encouraged before you make a choice, which fund manager to venture to or journey with, is what you need to do is to do what you call a background check. What's the motive? Where are they investing? Because it's very critical. Some, which I can say they are newcomers, you will discover that they're registering higher return that are so much attractive in the sense that you may not afford to ignore them. However, our encouragement will be clearly you must do the background check, just do your own due diligence, they're trading, and where they get support from, and on that to be in a position to make a choice if it's to join them and take the risk, or you do a comparison and also can do a call and see what makes them different from others, and we'll be able to answer you that question. Thank you.
Thank you, Tony. Miranda, we have a senior citizen on call, an esteemed senior citizen. Michael Njoroge shares a school of thought that believes that money market fund is not an investment product. And he proceeds to add that for senior citizens, we are risk averse and preservation of capital is key. What advice would you give Mr. Michael Njoroge?
For the belief that money market is not an investment product, it depends on what is your expectation from the money you have invested, sorry. So it is a good place to park your money as you either decide what to do with it, or as you accumulate it towards a goal that you have that requires high capital input. The beauty about money market is that I can go in with my 100 shillings. To buy a government bond, I need a minimum of 50,000. I think not so long ago, the Nairobi Stock Exchange enabled us. Now we can buy one share, but previously you needed to buy a minimum of 100 shares. So those who say money market is not an investment product is because it is again, I don't have a non-technical term. We call it a near cash item. It is easy to liquidate, but also it has a low entry level. With my 100 shillings, I can start it. I can collect this 100 shillings in that money market without being told to figure out how to grow it, and then come with my 50,000 to buy a bond or buy a treasury bill, for example. As far as senior citizens and preservation of capital is concerned, then you look at there are a number of low risk investments. They will not give you high return, but you have a higher degree of guarantee of both interest being earned and preservation of your capital. And those are mainly government instruments, that is treasury bills and treasury bonds. And after those two, money markets come close next to those. So if you're not looking for supernormal profits, you are okay with just beating inflation, there is nothing wrong with the money market fund. But if you have bigger dreams that you don't have money for right now, then the money market fund will be a perfect place to accumulate. So whatever you're accumulating is earning you a bit of interest, and also it is safe. To a large extent, your initial investment is safe. as opposed to if you buy shares, well, the price might 10x tomorrow, but it can also go down to zero. And when it goes down to zero, then you've even lost the little that you put in hoping to multiply. So money market is not bad for someone who is in retirement, someone who's looking to preserve capital. But also you could look at between what the MMF is giving you now vis-a-vis what the available bonds in the market are, and see what gives you better return at the point at which you are looking to invest. Because like currently, money markets are not doing very great returns, but also we understand that that is tied to the T-bill rate. So the lower that rate goes, then the lower the return will be, because then they are not allowed to lock people's money in very long-term investments because of the nature of this money should be accessible within a short period. If I ask for it now, I should get it. I think the longest I have had is in 5 business days. So I cannot go and invest in real estate because where am I going to sell a house in 5 days, get the money and pay this person whose money was invested in that? I hope I've answered, but if I haven't, you can have a follow-up question. And then, Clive, allow me to comment on the previous question as well. The one by Vincent. Vincent, I dare say, is financially savvy because he's asking all those questions that most people go into investing and do not ask. He's already thinking about how safe is his money. He's wondering whether the institutions he's looking to invest in are regulated. So CMA's website has a list of all the entities that are they regulate in as far as investment of people's money is concerned. So whenever you're in doubt, just go to their website, download that list and go through it. And then it can even give you a guide on which institutions should I check out, which I am very sure that they invested. Therefore, I have recourse in case of a negative outcome. I have somewhere to start to try and maybe recoup part, if not all, of my investment. And then the other question about where they are investing to get high returns is the one I had alluded to. If you cannot understand how a certain vehicle is making their money, please do not be lured by the high interest, because it means if 2 plus 2 is not becoming 4 at some point, things will fall apart. It's like the pyramid schemes we had. No one stops to ask, why is it that I have to recruit more members to make deposits for me to also earn a return? So when that pipeline dries up, then return stops as well. So I dare say Vincent is on the right track.
Yes, indeed. Thank you so much, Miranda, for that. As we close out on the Q&A segment, allow me to reach out to a few questions, at least 3, as we close out this segment so that we can transition to the next agenda item in this webinar. So Paul Mwangi asks, Tony, personal loans, are they dream killers? Is this, no, he puts out a statement rather. Personal loans are dream killers. Is this a myth or truth?
Maybe just outright, just to respond to that is that personal loans people take for personal development. Sometimes you may not have that much to initiate or invest. So a loan will help you jumpstart or invest in a project. So to me, where I sit as an expert, personal loans are good in the sense that will help you grow or help you invest, so long as you are taking it for a good cause. The challenge has been you take a loan for consumption. Let me use that word. Or where are you going to take that loan doesn't have a return. That is a bad loan for me to say, and that's a dream killer because you have to pay without having to dig deep to your pocket, sustain and paying the loan, and also with no return from investment. Where I sit now, personal loans are not dream killers. They are enabler for you to make you better and also grow for your investment. Thank you.
Thank you, Tony. In the interest of time, allow us to take the last two questions. Clearly, your presentations and interactions have led to more questions. Thank you, ladies and gentlemen, for posting your questions. There is one from Bonki Kimani. Bonki asks Miranda, in regards to taxation, which between the two is highly taxed, rent or MMF?
MMF, because your interest on money market fund is charged withholding tax of 15%. So if you make, for example, if this month the credit account, the interest you made is 10,000 shillings, they will credit your account with 8,500. The balance that makes it 10 goes into withholding tax. And then for rent, I think it's about 5%. But now it depends on, it's 5% of what and 15% of what. If you have invested in rental houses and you pay your 5% and the money that is remaining is enough to meet your whatever goal you're investing for. If your target was, say, to end up with a monthly income of, let's use 50,000 shillings for an example, and you end up with your 50,000, then you can go for your rent, because at the back of it, you have an asset that is backing your money. You are most probably going to make more money if you decided to liquidate a house, an apartment, let's say, than what you are having sitting in your money market fund. And then also remember, apart from the very risk averse, this money market fund is it's a collection point, in that I am accumulating for a bigger plan in the future. So yes, MMF will attract higher interest, but I mean higher tax, but depends on what is your future plan. Yeah, I think everything comes back to your goals. So once you get your goals right, you will align all your investment actions towards achieving those goals.
Yes, indeed. While we are crunching numbers, they say numbers don't lie, Miranda. Michael Njoroge asks, what is the return on investment in real estate? Do you have a number you can share with Mike Njoroge?
It is currently 7 to 8%, depending on where your property is located.
All right, thank you. There's also a request from Washuka Gitahi on the chat tab. She asks for more information on medical post-retirement product. Believe in the interest of time, we can pick that later, so that we allow the last question for Tony. Question coming in from Richard Owoth. Richard asks, does CMA, Capital Markets Authority regulation, guarantee capital preservation, even if there is no interest on the principal? Tony?
Thank you so much, Cliff, and thank you, Richard, for that question. In terms of regulation of guaranteed capital preservation, I believe in terms of the provider, whom we call a fund manager, I think they have tailored a product depending on what they want to say to the market. So, but now that we have just to confirm, probably revert back.
All right, thank you, Tony. So we'll give you feedback. Richard, thank you for your question. And now, ladies and gentlemen, we want to move to the next presentation. Before we do that, I want to thank Miranda and Tony for breaking down these myths in a crystal clear way. We'll now transition into the next segment, where Munge Shege will show us how to turn these lessons into real-life solutions. Over to you, Shege. Munge.
Thank you, Clive, Miranda, and Tony, for such a thought-provoking and engaging session. I also would like to thank everybody who participated in the Q&A, because this was a real eye-opener for me. So moving on to the next segment of this session is just basically to unpack for you one of the Jubilee insurance solutions named the Faida Elite. And as we do so, I would want just to maybe give some of you who have never heard about Jubilee an overview of who we are as a business. So Clive, you can confirm you're able to see what I'm sharing on my screen?
Crystal clear, you can proceed.
Wonderful. So Jubilee Life Insurance is part of the Jubilee Group, and this was incorporated as a life insurance company in Kenya over 87 years ago. That's in 1937. We have a presence in East Africa, that's Tanzania, Uganda, Burundi, and Mauritius. And we are happy to say that we have over 1 million lives covered, and we proudly say we are the most trusted insurer today. So why we mention we are trusted and why Octagon trusts us too is that if you look on your screens, you'll be able to see the kind of growth we have in terms of assets under management and part of our pension fund growth. So we won't go too much into detail for today. But what I would also want to point out is that we have a capital adequacy ratio of 143%, which is here for you guys. Is just a testament as to our acumen in investments and the trust that our people have in us. So as we move on into the presentation about Faida Elite, I would just want to quote an African saying that says, when the forest is on fire, the chameleon must abandon the walking style of its ancestors. So as Jubilee, having been here for 87 years, we have witnessed some changes in the world around us and back here in Kenya, our home. One of the things we are able to see is that there is a lot of inflationary pressures that are happening all around us that are really squeezing the disposable incomes of Kenyans today. In addition to that, we've also seen that outside and within our industry, there are a lot of solutions that are there for other Kenyans to invest. And therefore, innovation is very important for us as Jubilee to keep up with the times. So Faida Elite is one of our latest innovations. That's what I want to take you through. It's an award-winning innovation. We actually got an Aki Award for innovation this year. And what we're about to unpack is what differentiates us from the traditional insurance products that you have out there. Faida Elite ideally is just designed to provide you with investment opportunities that give you superior returns. We've also incorporated very flexible premium payment terms, and as well as giving you life protection during those life moments. So jumping quickly into the specific benefits we want to unpack for you today is one, a Faida Elite solution is competing in terms of returns because we are offering rates that are competing with money market funds, T-bills, and bonds. If I were to quote the last month return on Faida Elite, it gave our clients a gross return of 12.86% on the amounts invested with us. When you invest with us in the Faida Elite plan, we put that money into a portfolio that's handled by our Jubilee Asset Management sister company. On a month-on-month, you get a statement of your investments, just as you get with other instruments out there. And last month, the gross earnings were 12.86%. The main thing I would want to also mention is that unlike other investments out there, we compound your money on a monthly basis. So you get to enjoy the power of compounding as opposed to other companies which do it once a year. So there is a significant growth in your wealth when your money is compounded monthly as opposed to compounding your interest annually. The next thing I find important to mention is much as we are having it as a unit-linked product with superior investment returns, we also offer you adequate protection in terms of the life cover. We have put in a life cover benefit where the customer has the option of choosing the sum assured they would want. So the sum assured starts off at 100,000 with a maximum sum assured of 1,000,000 Kenya shillings with incrementals of 100,000 in between. So Munge can opt to have a sum assured of 100,000. Chege opts to have a sum assured of 200,000. A separate client 300,000. So you get to choose the sum assured which you would want in the plan you've taken up. What that means is you get to choose the portion of your contribution or premium payment that goes into the investment basket, as well as the portion that goes into the protection basket. That is something very unique within this industry, and it's a first coming from Jubilee. The next thing we put in place was flexibility in terms of premium payments. We do not have a cast in stone premium payment mode. We can allow you to save your money on an annual basis. For those who get incomes annually, you can put your money semi-annually. We have quarterly payment terms, or you can just give us the monthly if you're a salaried person like myself. And there are others who have disposable funds which they can opt to put in as a single premium for the term of the investment, and they wait for the investment to mature. So the flexibility of premium payments is something that we are offering you so that we tailor make the solution to match your cash flows depending on where you earn your money. The other thing we allow you to do with the Faida Elite investment plan is you can put in optional additional payments. For example, Munge is a salaried person who opts to save 20,000 shillings a month. At the same time, Munge may have a tea farm which pays him a bonus, like people are being paid this quarter of the year. And he can take a lump sum of that tea bonus and put it in. Chege may be paying quarterly because he runs a school. But once in a while, he has a maize farm or a wheat farm in Narok where he sells maize and he has a lump sum of money. You are able to put in additional optional payments. And as I mentioned earlier, we compute and compound your interest on a monthly basis. So it's to your benefit when you are putting in your spare cash so that you can have the compounding effect month on month. Now, another unique thing that we are quite proud to have introduced within our investment plan is that we are now able to offer our clients partial withdrawals or even access to full withdrawals even within the first year of the policy. Let me elaborate more on that. During the COVID years, we got to see people going through very trying moments. Businesses were struggling, some even went under, employers were laying off staff or even reducing their incomes up to 50%. And when people would want to come back and access their hard-earned savings, they would find that the terms of the products that exist within this industry of ours are quite rigid in that you are asked to pay up to maturity or you lose even the money that you've invested. So for us, we have put in what we call partial withdrawal benefit, which simply means that you can access up to 15% of your fund value. And fund value is the amount of money you've contributed plus the interest it has been earning. So you'll be able to access 15% of your fund value as a partial withdrawal benefit. This benefit, you are eligible for it from the 25th month. So what that does, it gives you peace of mind that if you're saving your hard-earned money and those life moments happen, you can be able to come and access part of your investments to cushion you through that financial challenge or difficulty. We have also said that there is a full withdrawal benefit. What that simply means that even within the first year of the policy, you will be able to come and access your full fund value, though full withdrawal benefit is subject to terms and conditions, which I am displaying on your screen on the bottom right of the screen. Within the first year, if Chege had given us a single premium, that's the column on your right, you would be able to say a single premium of 10 million. This within 1 year would have grown by the 12.86. He's able to come and withdraw in full, but there'll be a charge of 10%. Within the second year, if he was to access his money, the charge is 5%, and the third year is 2.5. But from the third year onwards, there is no charge. When somebody is paying in what we call regular premium payment terms, the withdrawal charges for full withdrawal is 15%, 10%, and 5% for year 1, 2, and 3, respectively. What that simply means is that in case Bunga is retrenched, he has access to his fund value. Please note that this fund would have been earning interest on month. So when you go to look at the net value he gets, especially from the 13th month, he still has a net gain and he still has a financial cushion and the peace of mind where he knows that should worst come to worst, he's not going to lose his investment and he's going to be able to access that fund to cushion him as he tries to regain his financial footing. The next benefit I am happy to announce that we have improved on compared to the legacy products we have is we have expanded the eligibility period up to 80 years. We've taken cognizance that unlike other players within the industry where they do not want to cover people above 65 years, we are allowing you, even at the age of 80 years, to start a fund. You will be able to enjoy the superior returns. Remember, we mentioned you'll even get a life cover of up to 1 million shillings, which you can use as a trust fund for your children or great grandkids' education, should you not be there. And we will put you on cover up to the age of 90 years. This is because we appreciate that today's world, people are enjoying longer lives, longer longevity. In today's world, people, even after the age of 65, still have very productive years in them, and they wish to enjoy stable returns from reputable companies such as ourselves. And that's why we expanded our eligibility age up to the age of 80. Another key thing is that irregardless of the sums you shall invest with us, we shall not subject you to medical underwriting. We are able to put you on board, and unless your sum assured is above 10 million, and I mentioned here in this product it's a million, we are not subject to any medical tests. You just come, fill up our application forms, which we are doing online through our JForce portal, and you are able to enjoy the superior returns with us immediately. We do also have coverage in terms of death, be it through accidental death, natural death. We mentioned the sum assured ranges from 100,000 to 1 million. And we offer you also tax benefits. I saw a question somewhere on tax, and I'm happy to say that one, the monies that you contribute towards this investment makes you eligible for tax relief at 15% up to a maximum of 60,000 shillings per year. And the maturity benefits are also not taxed. So when you're looking at comparable investments for you as a customer, you'll find that our T-bills, bonds, fixed deposits have withholding tax of 15%. Faida Elite maturity benefits are not charged withholding tax. When you are again contributing your premium payments, you are able to have them as tax deductible on your gross annual taxable income. So there's a twofold tax benefit in terms of the money you contribute makes you eligible for insurance tax relief, and the maturity benefits are not taxed. So holistically looking at the benefit structure, you find that this is a very, there is a compelling argument as to why you'd opt to move the FIDA Elite way. Here you are finding that you're getting high returns, good tax benefits, a life cover. You don't have the hassle of running after tenants if you decided to go the landlord way. And in a nutshell, that would be what we are calling the FAIDA Elite Investment Plan by Jubilee. And at this juncture, I would want to take a pause for a question or two, and maybe Clive, you will help me handle the Q&A. Thank you, and back to you, Clive.
Thank you so much, Munge Shege, Head of Alternative Distribution at Jubilee Life Insurance Company, unpacking that wonderful competitive solution that is the FAIDA Elite plan. So first question on the chat tab, Munge, is from Mary Goretti. Mary Goretti says, they are the good one, the good are. You mean one must start a fund, one can start a fund at 65 years. She proceeds to ask, what of premiums? Will they be too high? Over to you, Munge.
The most interesting thing about the FAIDA Elite Investment Plan is because it's a unit-linked product, we will not discriminate against you because you've been blessed with many years. So you will find that the differential in the premium would be quite minimal, and we shall be sharing some illustrations later on the chat page. But no, you will not be disadvantaged because you're coming in at the age of 65 or 70 or even 79 years. Yes.
Thank you, Munge. An anonymous question asks, do I get to pre-select the level of life cover on FAIDA Elite?
Yes, correct. At the point of application, one does have the option of choosing a life cover sum assured between 100,000 to 1,000,000 in incrementals of 100,000. So you have the option of choosing a life cover of 100,000, 200,000, 300,000, 400,000, 500, up to 1,000,000 Kenya shillings. So you have the option of choosing your level of life cover.
Sounds very, very flexible. Another question coming in thick and fast. What makes FAIDA Elite unique compared to traditional investment products in the market? And for anyone ready to start, what's the minimum contribution or easiest way to get onboarded?
So one unique thing about FAIDA Elite is that you have the option of having additional premiums. As I mentioned, you could be somebody who's salaried. Our minimum is 5,000 bob, so you can start off small with your 5,000 shillings from the salary. As and when you get extra income, you can be able to inject that, and we are compounding monthly. So we have the option of additional payments. Two, in case of financial difficulty, unlike other players in the market who will lock you into, say, a 5-year term, you must pay for 5 years before you get your maturity benefits. For us, we have partial withdrawal benefit, where you can access 15% of your fund value from the second year onwards. 15% of the money you've invested, you can be able to access it as a partial withdrawal with no charge to sort out your financial need. And this partial withdrawal benefit, you can actually access it up to 3 times in the term of the policy. Munga can have started off with FAIDA Elite insurance plan, and he needs 15% next year. The year after, he can still get 15% at no charge. And even a third time, he can still access another 15% without a charge. So over and above you being able to put in extra cash, you can also be able to pull out part of your cash and still continue enjoying the life cover. Alternatively, something adverse could happen and you need all your money right from the first year. We have said you can access full withdrawal benefit right from the first year, subject to the terms and conditions that mentioned. So that's a key differentiator in terms of, yes, it has a term of 5 years up to 15 years, but in between, even before the 5 years, should you have a financial emergency, the FAIDA Elite Insurance Plan has you covered in terms of partial withdrawal benefit or full withdrawal benefit. Thank you.
Thank you, Munge. Owino John asks, can you please share a brief write-up on the FAIDA Elite Investment Plan? Is there a brochure?
Yes, there is a brochure, so we shall be putting it on this chart, a brochure as well as some illustrations showing you the numbers. I know some people will be quite interested in that too.
Yes, indeed, because
And
it's in the
also on
numbers.
our webpage and our socials, you can go to Jubilee. Our webpage has a lot of information on FAIDA Elite, be it on Instagram, TikTok, Facebook, LinkedIn. Choice is yours. We are quite available for you. Thank you.
Absolutely. Thank you so much, Munge, for that. Indeed, the money is where the numbers are at. Stanley asks, in the instance of withdrawal before maturity, does the money gain interest or it's foregone?
When you're accessing your money, you will be accessing what we call the fund value. That is the principal you invested as well as the interest. We shall not penalize you or take away your interest. When you're accessing your money, you're getting what we mentioned is the fund value, which is your own contributions plus the interest.
Fantastic. Thank you for that. Someone else is wondering, if I need to start with a plan today, what are the steps? What do I need to do to get started?
All you need to do is share with us a copy of your ID and a KRA PIN. As I mentioned, our onboarding process is fully digital. We shall be able to populate an illustration which will come to you on email, and SMS will have an OTP where if you're satisfied with the output we've shared with you, you authorize, we progress fully automated to issue you with a policy number, and you begin investing your money in a very sound, stable company. Thank you.
Thank you so much, Munge, for that. There's also another question that has come in straight out of Uganda. All right. What happens when my cash inflow is interrupted and perhaps I'm not earning monthly, hence not able to save temporarily because earlier the conversation was around the plan compounds. So what would you tell Brenda from Uganda?
Thank you, Brenda, for asking that question. And the answer is your policy will not lapse. One key differentiator we have put in FAIDA Elite is that this policy will not lapse. Even if you have contributed and you're facing a financial challenge, over and above us giving you an option of partial withdrawal to sort out your financial difficulty, the policy does not lapse. The funds that remain with us after your partial withdrawal shall continue to be compounded monthly, and at maturity, you will get your fund value, which will be the sum of the principal you paid plus the interest it has been earning for the duration it has been with us. So rest assured that you will not lose your hard-earned money should there be financial difficulties in making your premium payments.
Munge, please also help us get the difference between money market funds and the FAIDA Elite product. What's the difference?
As I mentioned, one thing for us with Jubilee is we have really gone out of our way to innovate. So what we are giving you is the best of both worlds. You're having benefits which are comparable to what you get in money market funds. And unlike money market funds, you're not going to be taxed on your maturity benefits. And unlike money market funds, you're still going to be able to enjoy a life cover as your money earns a return that is superior to what you're getting in the money market fund.
Yes, indeed. And also see Eric Obaro has joined the conversation around the money market funds there on the chart tab. Ladies and gentlemen, remember this product is a collaboration between Octagon and Jubilee. With that said, we're also looking out for any other questions that may be streaming in regarding the FAIDA Elite product or any other question that we have not responded to. But if you want to use the microphone, please, you can proceed to unmute as we look out for those that want to verbalize their questions. There's a question that has come in here that the 1 million life cover lapse in case of default in payment of the premiums or savings on a monthly basis.
You will still have your life cover because, as I mentioned, it's capped at $1 million, Bob, and you'll find that the mortality charge that caters for covering your life will be, in case you've stopped paying your premium, the mortality charge comes from the fund value that is already existing with us. So should you face difficulty, we've mentioned that you have the option of accessing some of your funds, and this policy will not lapse. The funds with us shall continue earning interest on a month-on-month basis at the declared monthly rates, and the life cover you have will still be there for you. Not that you will need it. We hope you will survive to maturity and enjoy the benefits, but we shall not deny you the life cover just because you're facing a financial difficulty.
Ruth Kyoko asks, what's the least sum assured, the minimum sum
The,
assured?
the minimum sum
Minimum sum
assured
assured.
is the 100,000 Kenya shillings. 100,000 Kenya shillings is the minimum sum assured, and the maximum sum assured is 1 million Kenya shillings. So minimum is 100,000.
Mary Goretti says this is a very interesting product, Munge, very innovative indeed. She needs an illustration. And then thereafter, we are still waiting for that brochure on the chat tab and the contacts for those that would want to start on this plan today. We are ready for you. So please illustrate for us. Do you have some numbers that you can showcase for us?
If you'll allow me just 1 minute of
Sure.
your time, let me see whether I can pull up a quick illustration from my desktop. Just a minute.
No worries. As you do that, Timothy Mushiri says, good job, Octagon. So informative. Keep it up. And I'll circle back to earlier comment by Eric Obaro. So we've had a conversation between the different products, different investment vehicles. So Eric thoughts are that money markets are good, they're straightforward, they can be liquidated. It circles back to the contributions made earlier by Tony, Miranda, and now, of course, while Munge Shege was presenting, we also did differentiate between the MMF and the FAIDA Elite. Munge, we are ready when you are.
So, Clive, are you able to see what I am sharing on my screen right now?
Not yet, highly likely still loading, though I've seen you've taken control of the screen, so it should come up shortly. But you can start speaking to it as it loads.
So,
not yet, Munge. You'd want possibly to reshare so that we're able to respond to Mary Goretti's query in terms of what are the numbers like, what is the illustration like, what do the actual returns look like. So the illustrator is very, very important in this instant. Remember, ladies and gentlemen, This is a webinar powered by Octagon and Jubilee Insurance on how to make your money work for you. Today, we have been talking about the myths versus the realities. And we still have room for your questions up to the top of the hour. So feel free to drop those questions on the chat tab so that Munge, Miranda, and Tony will be able to respond to all those questions that are coming up. We can have a team member from trading assist in uploading the illustrator. Seems there's a bit of challenge from Munge's side. It's in the numbers. They say we trust in God. Other people must bring the numbers so that we see where are the numbers at. If I put in an X amount, what comes out after a certain period of time, even as I enjoy a life cover under the Faida Elite products that we've been told that is highly flexible, highly competitive in terms of return. And Munge has further gone to demystify that it is different from the money market fund. We seem to have lost Munge. Philip?
Hi, Clive. Indeed, Munge is joining up in a minute.
As Munge does that, I'd like to give an opportunity to our earlier speakers, maybe to make their remarks potentially, even as we get back to Munge to give us the illustrator. I see some questions that have come in, so we'll reach out to Tony and Miranda to give a closing note at the very end. Pauline is asking, is it possible to receive brochures via email as well after the call? So Philip, will you be able to send out the brochures after this call?
Yes, Tony will reach out to all participants of this webinar, and he has everything, including the illustration, the fact sheet that shows you the projections, how much you've been able to declare since the start of this solution, and he's also able to tailor make a response based on each client's need. So that will happen after this webinar. Thank you.
Thank you, Philip. Ladies and gentlemen, remember this is a collaboration, co-creation between Octagon and Jubilee. Philip, while you still have the mic as we wait for Munge to come back, Kenneth Gituma says, I have an education policy with Jubilee Insurance. I'm completing the premium by June. There are things I've not understood. Would you please advise me? So maybe, Philip, you can take up or collaborate with our colleagues from Octagon so that you reach out to Kenneth and assist him. Mary Goretti, thank you for your kind remarks. All presentations were very informative. Can we contact the presenters via email for further engagement? So presenters, please give us a channel to reach out to you. Clearly, you delivered impactful presentations. I don't know if you want to post that now or it will be shared out to our esteemed members on call.
Sorry, Clive, it seems I had a challenge with my connectivity.
Welcome back. Welcome back, Munge.
So, Clive, can you confirm if you can see anything on the screen now?
Yes, I can.
Fantastic. So what I've put up on my screen is just an illustration of somebody who is saving 10,000 shillings a month, which translates to 120,000 shillings a year. And this is a 7-year plan. That's why you will see the duration will come from year 1, 2, 3, 4, 5, 6, 7 on the column on the left. Here we are looking at a client who is aged 48 years. That's on the top left, paying monthly. As I mentioned, you have the options of paying semi-annually, quarterly. Clive, you have a question?
The screen has not moved from my end. Maybe I'm experiencing a screen freeze. Are you displaying an Excel sheet?
A PDF with a table.
It has not opened, but we see your PDF files. Maybe
Okay.
you can open it.
I think we're having very slow internet connectivity here. Tony, from your end, are you able to see anything different?
Thank you, Nan.
So you're still stuck on a folder?
Yes.
Okay, let me stop sharing. I will put the quote on the chat table, then maybe we can discuss it from there a bit later, because it seems when I'm trying to share this screen on my machine, it's giving us a bit of a problem. But as I do so, any further questions, Clive, from the chat?
No further questions on the chat. We want to apologize for esteemed members. We were not able to broadcast those numbers from Munge, but of course, there'll be further interactions because even as it displays, we are alive to the fact that people have different ages, different incomes, so you'll have different illustrators. Thank you so much, Munge, for unpacking that presentation. For those that wanted an email to use to reach out to Octagon. So Elizabeth, thank you. The email is training@octagonafrica.com. You can see it on the chat tab. Please feel free to reach out and ask all your questions. Ladies and gentlemen, we have come to the tail end of our webinar. At this particular time, I want to circle back to our panelists, Human Capital, Human Amari, seasoned speakers, to take a minute to make their closing remarks. Then we'll close out this webinar. They say ladies first, so I'll start with Miranda.
Thank you, Clay. I think in as much as I was one of the speakers, I have also gained a lot of knowledge and insight from the discussions that have been going on. And I hope to interact more, especially with those who have expressed interest in reaching out. So thanks once again.
Thank you so much, Miranda. We now move on to Tony.
Good afternoon again, members. Indeed, it was a great opportunity to interact and have the time to discuss in regards to do with money. We look forward to engaging you more, giving more solutions, and making sure we work together with you, assist this journey together in regards to money. So I'm happy you got opportunity to log in and ask those questions and understand where you're heading in regards to our money. Thank you and looking forward to see you next time. Goodbye.
Thank you so much, Tony. Last but not least, we'll wrap it off with the closing remarks from Munge Shege.
Thank you, Clive. Thank you, Tony. Thank you, Miranda, for such an engaging session. And most of all, thank you to the participants who took the time to come and hear from us. We are looking forward to much more. We have more products coming up. We have our partners, Octagon, who are closely liaising with us. So be looking out for these webinars. In the meanwhile, please reach out to Tony with any further questions or queries, and we shall be able to give you fantastic solutions. Mine is to wish you a great evening ahead, and God bless you all. Thank you, and back to you.
Thank you so much, our esteemed panelists, for sharing your pouring your wisdom, your financial wisdom accumulated over the years. Thank you so much, esteemed members and support teams that made this webinar possible. Remember, this has been the Octagon Jubilee Insurance webinar on how to make your money work for you. We've been able to differentiate between the myth and the realities. Thank you so much. My name has been Clive Angwenyi. I have been your moderator this afternoon. Enjoy the rest of your day and see you at the very top. Asante.